You wrote a scathing piece in the Financial Times this week. I want to start with a quote from it. Failure to act promptly would turn the Fed's increasingly discredited transitory characterization from one of the worst inflation calls in decades to also a big policy mistake with widespread and unnecessary damage. Mohamed, I want to start with that single piece there. One of the worst inflation calls in decades. Why do you think it's this bad?
Because they didn't show humility at the beginning of the process, and that's something that you and I talked about. There are lots of structural changes going on in the post-pandemic economy, even though we're not quite there, but post-immediate shock. You can't simply dismiss them as transitory. You've got to respect the fact that behaviors change. And they just didn't have the open mindset enough to see that. So they got stuck in this narrative, and they held on to it for too long. And the result of which is they're looking at inflation that is much higher than they ever expected. They're looking at inflation that's much broader than they expected. And they're looking at inflation that's going to last even longer than they expect even now. So it's going to go down in history as one of the worst inflation calls by the Federal Reserve.
Well, let's work through the incoming data. Mohamed, what is it about the incoming data that's making you more confident of this call, not less?
So, John, I've been confident of this call for a while because I talk to lots of companies, and you clearly see what's going on from a bottom-up perspective. Wages are going up. Prices are going up. Expectations are that supply chain disruptions and labor shortages will last into next year. And there is confidence that pricing power remains. So put all these things together and you get this cost push inflation. There's also a demand pull inflation component in it. So when you put all these things together, you've got to respect the probability that inflation will remain high and will persist for much longer than most people expected.
Mohamed, what do you think it would take to change the minds of people that disagree with you? I asked Vice Chair Rich Clarida earlier this year, what would be the tell? How would he know that he might be wrong? And he would say it would be the turn of the year. This is what he said earlier this year. He said the turn of the year would get a better idea of how temporary these factors are. The turn of the year is right in front of us right now, and I don't hear this Federal Reserve changing their mind or pivoting anytime soon. What do you think it would take?
So I think the vice chair in his latest remarks did show a little bit of acknowledgement that inflation is well above what he expected. And what will it take? It will take a few more prints. It will take labor force participation not bouncing back as fast as we all wanted to. To be clear, I want to be wrong on this call. I desperately want to be wrong on this call because if inflation ends up to be hotter for longer, it has very unfortunate economic, financial, institutional, social, and political implications. So we all want to be wrong on this call, and we all hope that inflation is going to come down very quickly, very soon, but I don't think that's going to happen, John.
You're making two calls here. One, this is the worst inflation call in decades. You think we're already there. That sounds like a conclusion to me. The next call is that we could make the biggest policy mistake. Now, it's the policy mistake that you don't think we've made as yet. You think the window, though, is closing. How big do you think the window is?
It's small. It was wide open when you and I started talking about this in March and April. The economy was doing extremely well. That was the time they should have started tapering. They didn't. Now they're going to start tapering, and the concern is that the time between ending the taper and interest rate hikes is not going to be significant. In fact, they may even overlap. Look at how the Bank of England is thinking right now. And in addition, they're going to have to raise rates much faster than they would have otherwise. That's the policy mistake, that you could have eased your foot off the accelerator, but you didn't. And now you're going to start tapping the brakes at a time when there will be three other contractionary impulses on this economy. That's what the policy mistake would look like, John. I hope it doesn't happen. There's still a window to avoid it, and it would start in December by the Fed accelerating its taper program.
Why do you think accelerating the taper would make a difference, Mohamed? Within the piece, you acknowledge the supply chain bottlenecks which have contributed to elevated inflation, although we can both acknowledge, as sitting here, that it's not just that. Why do you think accelerating the taper would make a difference?
Because initial conditions matter. When you set policy, you've got to know where you're starting from. And we are starting from emergency level monetary policy at a time when the immediate emergency has passed. So if we continue with this pedal to the metal approach to monetary policy, we are going to destabilize inflation expectations. And if we destabilize them in a serious manner, then we're going to have an additional layer of inflation driver in the mix. So we want to limit it right now to demand pull, which will come down with time, cost push, which will come down, but at a slower pace over time. The last thing you want to do is add a third one, which is a fundamental de-anchoring of inflation expectation. It is the Fed's responsibility to ensure that it doesn't destabilize inflation expectation.
What this seems to come down to is a disagreement on what it would take to have a sustainable recovery that leads to the objectives that you want to achieve and the Federal Reserve want to achieve as well, Mohamed. What I've witnessed this week is an acceleration of the calls that speak to what you're talking about. More rate hikes next year, 2 from Wells Fargo, Bank of America looking for more of the same. Wells Fargo put out a call, though, along with that rate hike call this morning, Mohamed, that I thought was interesting. They're looking for 5% CPI next year, on an annual basis 5.2, but real GDP growth with a 4 handle. This is where I want to understand from your perspective, Mohamed. Are you looking for elevated CPI through next year that hurts growth, or can we still achieve real GDP of something north of 4%?
So we can achieve high GDP. We have to achieve high GDP. Also, we have to make sure that the most vulnerable segments of our society don't suffer because of inflation. Remember, inflation taxes the poor the most. So this is doable, John. Policy-wise, this is doable. I want to stress there is a window. Yes, you can have relatively stable inflation and you can have satisfactory economic growth. But the concern I have is the following, is that not only are we going to have lower growth than we would have otherwise because the Fed is going to be late and then it's going to have to overcompensate, but in addition, we risk in the risk scenario, I want to stress the risk scenario, the following configuration in the middle of next year. Monetary tightening, financial conditions tightening, household tightening because savings have been eroded, and fiscal policy impulse dying down. And that would be tragic if we inadvertently end up creating these 4 headwinds to our economy.
And you know why some people disagree with you, Mohamed? They look at the last cycle and they say we should have been more patient. They've been conditioned by their experience for the previous 10 years. They're applying it to this cycle. I think that's where we need to finish, Mohamed. Why is this cycle for you, this environment right now, so different to what we experienced 10 years ago? And why are the conclusions from the previous cycle not applicable to what we're witnessing at the moment and for the years to come?
Because the prior cycle was characterized by deficient aggregate demand. The problem was demand, was not supply. This cycle is characterized by deficient aggregate supply. Demand has been bolstered by massive inflows of liquidity directly and indirectly, and by all sorts of fiscal transfers. The problem is not demand right now. Overall, there are segments, the most vulnerable, again, where there is a problem. But overall, the problem is deficient aggregate supply. And the problem in the community is people's mindset is still anchored by deficient aggregate demand. I've seen it before, John, coming out of the global financial crisis when my PIMCO colleague and I were saying, be careful, this is a new normal. These are secular forces in play. We were dismissed by all those who had just a cyclical mindset. It took 4 years for that mindset to change. And we lost a golden opportunity to maintain living standards.